there will come a point where the dollars and the treasuries lack the demand sufficiently needed to run this country, and the mountain of debt that needs to continue to be sold to the world to finance our exorbitant standard of living. I think those days are coming. And when that happens, you see interest rates go to the moon to compensate for all of those dollars hitting our shores, as they're no longer desired or even forsaken or dumped in favor of other things. And to me, gold seems very much like a treasury in the respect it continues to move higher and it lacks counterparty risk. I do think that there will come a time where it becomes very obvious that there really isn't a demand. You can see it already with the long tails on the treasury auctions of any duration.
Traders and central banks lack a clear replacement for the dollar among the world's other currencies, and that makes physical gold shine as a reserve asset. Gold is no one's liability. It is no one's to control. Even now, 50 years after it was officially cut out of the global monetary system, gold still represents the ultimate form of payment. AndySchectman, president and owner of Miles Franklin Precious Metals, foresees a future where declining demand for the US dollar and treasuries positions gold as a viable alternative. The decline is not a temporary setback, but the result of a sustained negative trend. The U.S. currency's share in central banks' foreign reserves has dropped from over 70% in the early 2000s to under 60% today. According to Andy, gold has steadily grown over the years, outpacing the S&P and bond market. Gold has outperformed both stocks and bonds since the turn of the century. Gold was among the best-performing assets of 2023. According to an analysis by the World Gold Council, gold outperformed emerging market stocks, U.S. bonds, the U.S. dollar, global treasuries, and commodities in general. However, from 2020 to 2023, the average annual prices of gold have increased, showcasing its resilience as a long-term store of value. Meanwhile, he believes that gold's historical stability and resilience make it a superior option to U.S. treasuries. In the present situation, a growing number of central banks no longer view the U.S. Treasury as a safe haven during turbulent times. Instead, global central banks are showing a growing inclination to gold as a means of hedging portfolio risk. This shift toward gold as a reserve asset favors increased demand and value for gold. Andy highlights a potential third pricing tier for gold and silver on the Shanghai Gold Exchange, with higher values than the West. Now we present the clips of AndySchectman's insights from his recent interview with Rafi Farber. Before we continue to delve into this discussion, please subscribe to our channel and activate the bell icon for timely updates.
The way part of the world is looking at it right now, I think they're looking at it as a savings bond, because in a historical context, using another country's debt as an asset has a very small window of history behind it. And like you said, if you go back to 2000, S&P's averaged 7% per year. Gold has averaged 7.8% per year. It's outpaced it. If you look at the bond market, it's killed it. And if you just look over over the last few years, it's done the exact same thing. It's outpacing just about everything and moving in a way that I think you could argue is very slow and steady. Like, for example, in 2020, the average price of gold was $1,773. In 2021, the average price was $1,798. In 2022, it was $1,801. In 2023, $1,943. Now, you could argue that it should be higher, or whatever you want to say, but it's doing its job, and it is slowly winning the race. In the end, the tortoise won the race, and I think that's what you see here. And you can go back and pick any time period and look at it in terms of what it purchased you then and what it purchases you now, and you'll see it's remarkably stable, and it retains your standard of living or your purchasing power over an extended period of time. The problem is, too many people have grown accustomed to instant gratification not being fast enough. And I think that's why gold is something that when you inject the volatility that we see typically in the metals markets, it's something that gets really unnoticed by the majority of people, because it's not flashy. It doesn't move at breakneck speed and doesn't pay any interest. And there's really been a whitewashing of what gold really is. So, to me, it is better than a U.S. Treasury because you don't have the default risk. It's an asset that is not simultaneously the liability of anyone else. So I think that's how part of the world is beginning to look at gold as they shed treasuries and look at gold for what it's always been, and that is a supreme store of value and a very liquid one at that. It's actually a third price for gold, and that's and silver, and that's what's happening on the Shanghai Gold Exchange, where silver is being priced over 10% higher in Shanghai at $2.50 higher than it is on COMEX and the LBMA, and gold has a varying degree from 4 to 7 or 8%. So, you're starting to see, and I don't know, maybe you have a different take on it. I look at it as the beginning of arbitrage, where they're slowly turning up the heat to arbitrage as much of the metal to incentivize arbitrage, where the traders will say, look, we can get $100 more an ounce in Shanghai or $2 an ounce more in Shanghai and silver. Let's send it over there. And I think if that is indeed the case, I think that is certainly genius, because that's really in the end what they're trying to do is accumulate as much as they possibly can. And I think Zoltan Pozsar said it best. We are entering a period he called Bretton Woods 3, where we're moving away from opaque debt instruments to transparent commodities and things that you need rather than promises by a government like the United States. So maybe we're beginning to see a third price, and that is the Asian price, or the Eastern price, which is higher than the West.
AndySchectman reflects on 2008, noting a surge in physical metals demand despite price drops in derivatives. During the 2008 financial crisis, the demand for gold increased as investors sought a safe haven asset. The price of gold increased from around $700 per ounce in 2008 to around $1,900 per ounce in 2011. The economic uncertainty caused by the financial crisis led investors to seek safe assets, and gold was one of the best options available. Furthermore, he draws parallels to 2020, indicating a scarcity of silver below 20, highlighting the divergence between paper and physical markets. When precious metals rallied in 2020 on the back of lockdowns, interest rates slashed to zero, QE, and general market fear, silver's gain was double that of gold. The price ran up 43% from January to December 2020, compared to gold's mere 20.8% rise. Earlier in the year, as gold punched above $2,000 an ounce, a 39% gain, silver rallied to nearly $30 an ounce, a 147% increase. Let's get back to the interview.
I believe that to me, gold seems very much like a treasury in the respect it continues to move higher and it lacks counterparty risk. I do think that there will come a time where it becomes very obvious that there really isn't a demand. You can see it already with the long tails on the treasury auctions of any duration. That
I think there was
there
another
will come a
one.
time.
There was another one today, another tail, I think, the fourth one in the
Yeah,
row.
and that's I mean, who in their right mind would loan us money for anything longer than 6 months? I think it's crazy. And I think the world sees that. And then they look at this country, which used to be the beacon of, like, for example, justice, Lady Liberty, blindfolded, holding the scales of justice. They're not balanced equally. I think people would agree with that. And the way that our elections, we supposedly have the freest elections in the world, and people are looking saying, really? Is that really the case anymore? And all of the things happening here in this country, to me, accelerate the ultimate dollar demise, on top of the mismanagement of the world reserve currency and the sanctioning of assets and all of the things that we are doing. And then when you take a step back and realize that the number one economic advisor to this administration is a man named Jared Bernstein, who advocates for losing the reserve status, that it's a privilege we can no longer afford, everything starts to get a little bit more spooky and conspiratorial. But anyways, bottom line is, yeah, I do think that will happen. I do think there will come a day where getting precious metals becomes impossible, and it'll happen just like that. Because what is flush and low premium in terms of supply and premium right now, in the blink of an eye, will change when you have, the majority of America wake up to the reality that there really are very few safe places to keep your money any longer. I will tell you, and I'll say it again, gold and silver are not an investment. They are wealth. And where we are heading, I think it's never been more important. I think the big ugly buzz phrase over the next few years will be counterparty risk, and minimizing or completely, taking counterparty risk out of the equation, to me, is valuable. So in 2008, let's just suspend the fact that we're talking about gold and silver. We'll call it investment A and investment B. Investment A fell from 1,000 to 700, and investment B from 21 to 9 in the period of roughly a week. And whatever those investments are, I don't care if they're stocks, bonds, real estate, or metals, If I told you that in a span of a week, investment A fell by 30, 35% and investment B by almost 65%, I think it would be pretty easy. You don't have to be economist to say, yeah, there's no demand for that. People are selling. There should be an overwhelming amount of supply on the market as everyone's dumping it as the price is cascading. But it couldn't have been further from the truth. And my eyes really opened up at this point because we see at that point, every major mint in the world, when this happened, within 1 week of it happening, was sold out of product. The US mint was 12 to 18 weeks back ordered and told us we could place no orders at all for a couple of months. The
Talking
Rand
about
mint in South
2008?
Africa, 2008, yes.
Right.
The Rand mint in South Africa ran out of product for the first time in its 60-year history. The Australian mint, Perth mint, took no new business after August, and the Canadian and the Austrian mint were 8 to 12 weeks back ordered, but for a period of time could take no business whatsoever. And I was thinking, we're going to go out of business. We can't get any product. We can't do anything. I was getting phone calls from distributors in Ireland were saying, listen to me, we have an account at Delaware Depository. They would say, we'll take anything you'll give us because we can't find anything in Germany or Switzerland where we typically buy our supply. Every single refinery, mint, and dealer across the globe was out of product as the price was falling. So the paper price got driven down, and everything that wasn't nailed down, that was physical, got gobbled up. And so it was a situation where I really began to understand that there were two distinct markets. There was the physical market and the derivative market, and the derivative market was controlling the price of the physical market. And I guess you could say the same thing was true in 2020, with the exception of we didn't see the mass sellouts that we saw when silver went down to $12. The one similarity here is that you couldn't find anything for under 20.
Historically, gold has always delivered a positive monthly average return during on-hold interest rate periods. Moving ahead, we anticipate gold to witness fresh all-time highs in 2024, with $2,250 still achievable in the first half of 2024. How do you envision the role of gold evolving as a safe haven in the future financial system? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.